Hello, Dan Passarelli here. How are you feeling today? Today, we're going to talk about how to manage risk in option trading. And before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Now, I want to make sure that you can hear me and that you can see my screen. Give me a 1 if you can hear me. Go to the questions box, Q&A box. Give me a 1 if you can hear me, and a 2 if you can see my screen, how to manage risk in option trading. Please hit that questions box right now for me. That'll let me know that you can hear me and see me. All right, I got 1s and 2s. Omega can only hear me. What the heck? I think you can hear me. I think you can see me too. All right. So this is my first time being honored here to be on Firstrade, and I'm pretty excited about it. For those of you who are not familiar with me, my name is Dan Passarelli, and I have been in the options industry for about 30 years now. You wouldn't know it by how youthful I look. I dye my hair gray to look a little bit wiser. Yeah, I am an author. I'm an author of 2 books on option trading that are recently popular, with a third one on the way. I am a trader, lifelong trader. I've been a trader for more than half of my life, more than about 2/3 of my life. And I'm the founder of Market Taker Mentoring, which is the leading option trading education company in the world. And I'm also a trading industry collaborator. I've worked with every major options exchange, literally in the world, and all of the best options brokerage firms, including and especially Firstrade. And I'm also a family man, married to my wife, Kathleen, and have 2 children who are grown now, Sam and Isabel. And those are the things that are the most important to me, is my family. And other things that are important to me is I'm a runner, I'm a foodie, I'm a traveler, I'm a musician, been all over the world together, as a family. Love going out to eat, spend too much money doing that. I love to cook as well, run a few marathons. And what else? Yeah, I guess that's me. So now since it's not just your first time meeting me, but my first time meeting you, tell me a little bit about you. What is it that you most want to get out of attending these online trainings with me on option trading? What do you hope to get out of these trainings with me here with Firstrade? Hit that Q&A box and let me know, please. Risk management and profits. Excellent. Those are the 2 most important things, aren't they? And I would say you probably put those in exactly the right order. How to manage risk and profit, says Chirag. Great. I love it. Oh, FG's a newbie. Good, 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 good. I love that. Always start learning before trading. Risk reward ratio. Yeah, that's great too. Excellent, excellent, excellent. Well, what is options and all knowledge of it? Yeah, Omega. Starting out with the alpha, going to the Omega. I love it. Okay, good. Well, yeah, it's no surprise that a lot of folks are here to learn about managing risk and risk reward and that kind of thing, because, well, that's the title of this presentation. And so let's talk about risk. We're going to preface everything else that we're going to talk about here. When we think of the word risk, we think of the possibility of something bad happening, right? Like, oh no, there's a risk that I might be late. There's a risk that, it's raining out, I could crash my car. That's what we usually think about when we think about the word risk. Now, in trading, we have to think about that as well, but we also have to think about some other things too. We have to think about risk, and that's our primary concern. But we need to think about also how much we can make, the reward. Those are both important things. And in reality, risk and reward always go hand in hand. And in fact, they're two sides of the same coin. But there's another coin. And that other coin is likelihood of success. So what we really have is risk reward versus likelihood of success. And when we put those together, now we can really deeply start understanding risk and trading and how to run a trading business and gain consistency. So let's talk about this risk paradox. And as you can see here, I'm the sort of fella who likes to get in the trenches with my peeps here. So I like to do a lot of interactive sort of things and ask questions. And here's a question. This is what I like to call the risk paradox. Let's say there is a stock that's trading at $200 a share. I'm going to give you a choice of two positions, position one or position two. Which is riskier? Buying a 14-day at the money call at 560 or buying a 14-day 220 call out of the money at 32 cents. This is an exercise, and I want to know what you think. I'm taking a little survey poll here. One is buying the 200 straight call, which is exactly at the money, and you're paying more for it. In that regard, you're risking more. Now, choice two is buying the 220 strike call that's 10% out of the money at just 32 cents. So in that regard, you're risking less. If the stock really takes off to the upside, you would have a great deal more leverage profit with choice two. But if the stock goes up just a little bit, if it goes up to 210, choice one is a winner and choice two can be 100% loser. Difficult. This is a tricky question, isn't it? We got an which is probably a pretty good choice to tell you the truth. Chirag, and I hope I'm saying that correctly. If not, feel free to correct me. Says option one. FG says option one. Omega says option two. Remaguiz, I hope I said that correctly. If not, feel free to correct me. Says option two. If there's an earnings close by and the stock has been volatile, well, yeah, that kind of volatility does come into play a little bit here, doesn't it? And we don't know what kind of stock this is. Is this a really boring stock that barely ever moves? Or is this a stock that whips around a lot? Volatility plays into this in a lot of different ways. I'm saying it correctly. Oh, good. Remaguiz changes to choice one. Option two might be more risky. Okay. We got an option two, we got an option two, we got an option one, we got an option one. And so here's the thing. There is a correct answer to this. There is a correct answer to this. You know, there's a lot of things we don't know about this stock. Jeff says one. There's a lot of things we don't know about this. One of the things we don't know is what kind of stock it is or if earnings are coming. I mean, there's a lot of things we don't know. But you want to know the right answer? The right answer is they're both the same. At least if we believe in the options pricing model and that we believe that options are somewhat fairly valued. That's what economists call an efficient market, which I would say is not necessarily true. There's some truth to it, but not a lot of truth to it. They're really just different. One has maybe a worse risk reward. You're risking a lot more. And, you know, if in either scenario it goes up to 210 or 220 or 230, well, if it goes up to 230, you actually make less on choice one. But it's so much more likely that it'll work out. Choice two is a lot less likely it'll work out, but you risk so much less. It's just different. So managing risk in option trading always really comes down to two different stages. And if you're taking notes, this would be a good thing to write down. The two stages are constructing the trade and managing the trade. In the constructing the trade, that is doing all of our research, our analysis, technical, fundamental, volatility, looking at indicators and moving averages and all that, getting the trade just right. Why do we care about that? Because all the analysis we do guides what sort of trade we put on, right? If we're bullish, we could buy this call or we could buy that call or that call spread or sell that put spread. We're going to talk more about that in a second. We want to always select the choice that has the best risk reward. And then once we do, and we put the trade on, that's set. Okay. That's like, you know, if you go to the casino, you're playing roulette. At some point, you put your chips there, and the dealer says, okay, that's it. Get your grubby hands off the chips. That's it. No more bets. That sets the tone. That sets your risk reward and your probability of success, which arguably changes on a second-by-second basis, but at that point, that's what it is. And then managing the trade, which is how you can further control your risk after that. It's sort of like, well, let's change the analogy to a pinball machine, right? You know, the ball shoots up this way and it's coming down, but, you know, you shake it enough, maybe you can control it a little bit, hit the paddles at just the right time. So let's start from the beginning here. Let's talk about exploring opportunity. So our goal is to set up a trade with optimal risk reward versus likelihood of success. Now, that example before in the risk paradox, in theory, just from an option pricing theory standpoint, they're both the same. But there were a few really smart people here who said, hey, you know, it depends on if earnings is coming out. I would have to assess the likelihood of the stock going up or down. I would have to assess some different things, right? That's going to guide you as to which in that situation is actually superior to the other. Because one has different risk reward, one has different likelihood of success. So this is something that I teach to all of our student traders at Market Taker Mentoring, and I want you to write this down. In fact, if you get nothing else out of today's workshop, this is what I want you to get out of it. You want to identify 3 choices of trade to put on, and then you're going to pick the best choice. Before I go any further with that, let's just look at it as an example, because I know you have questions. How do I know which is the best choice, etc.? Oh, anonymous attendee says, hello, I got to leave. Will this webinar be recorded? Where can I watch it? Yes, it is recorded. And I think the good folks at Firstrade will make that recording available. This being my first time here, I'm not sure exactly where that comes. Maybe you get an email with the recording. I don't know. If not, you can look in the educational part of the website. All right, so let's say we're studying Apple here, okay? And this, by the way, is just a hypothetical example. I'm not actually analyzing this. I don't necessarily agree that this is a great trade or a trade that I want to do or anything. This is purely just for example, so that I can make points, so that you can learn something to take away with you today, so that you can start making better trades immediately following this workshop. What do you say? Is that a pretty fair deal, do you think? What do you think? Is that a good idea? Hit that Q&A box. Give me a yes or no. Is that pretty fair? You like that? I want to be able to leave here and take some things away that you'll have in your brain for the rest of your life to help you be a better trader. That's my objective here. It's my objective always with you and with our students at Market Taker. Okay, so we're analyzing Apple here, and we see, we just have the, the little crosshairs here. We hover right about here, and we see, look, okay, at this point, it kind of hit 183, which, we had a wick through there, which is no big deal. We had a body that kind of stopped there. We had a little coagulation, but it went back higher. Here's where it busted through and had follow through. Here's where we had, a bounce off it. Here's some coagulation. Here's a bounce off it. Goodness gracious. Doesn't this look like a pivot point to you? A pivot point, by my definition, is a support or a resistance line, because they're basically one and the same, aren't they? In this case, because Apple is above it at this point, it's a support line. And we look at the RSI, and we see that there is a little bit of momentum to the downside. It's not exactly oversold just yet, but surely not, overbought by any stretch of the imagination. This is sort of just an inconclusive thing. So let's just say that in this case, we're looking for a bounce higher off support. So first of all, there are a number of things that we need to take into account. And if I were able to spend a good 3 hours with you, I could go through my whole checklist for finding trades. And let's see here, I've got my schedule. We're going to do that probably in a few weeks. I'm going to go through my personal checklist for trading options. Would you like that? But one of the things we have to consider is not just, hey, I'm expecting a bounce higher, but how much higher? Is it what they call a dead cat bounce? Sorry, cat lovers. I know that there's a documentary out there. I'm not trying to stir the pot or anything here. But a dead cat bounce where it just kind of bounces like 50 cents higher and sits there. Or a pretty violent bounce back up to 200, up to the previous resistance level, or somewhere in between. We've got to consider that. We've got to consider the time horizon. We've got to consider what happens to implied volatility, et cetera, et cetera. But for now, let's just say a bounce higher. And in fact, going through this exercise of choosing 3 different choices actually helps us figure out that process. So there's one thing that I could do is I could buy calls, right? If I think a stock is going higher, I could buy calls. And so which call would I consider buying? Well, we kind of talked about this. If I think that the stock is going to really take off to the upside, I'm probably better off buying an option that's pretty far out of the money so that I pay less, and delta increases because of what we call gamma. And I don't want to get too fancy with the Greeks right now. We'll talk more about, in fact, I've got a whole training in just a couple of weeks. In just a couple of weeks, all on the Greeks. The Greeks being the book that I wrote is Trading Option Greeks. That's near and dear to my heart. So we're going to care about all of those things. But look, like if we think that, let's go back to that chart. if we think, oh yeah, the next stop is going to bounce within the next week up to 200 and beyond, well, we probably don't want to just buy the 195 calls in case we're wrong. We probably want to get a little bit more meat on the bones. Maybe something like, well, let's see. Amazon's at 182. Oh, hold on a second. It's saying Apple. Look, it's just like magic. Amazon was at 182.80. So we'd probably want to buy something sort of in the middle, like the 190 calls. Why? Because it's sort of the best of both worlds. We get an option that's a lot cheaper than an at the money. And at the money would be 375. This is about 22% of the value of that. It's about 27% of the value of that. But the highest gamma, the delta changes is for at the money options. So when we buy an option that we expect the stock to rise to and then through, it goes from a nice little cheapo option to the delta getting bigger and bigger and bigger, faster and faster and faster, because it goes to the highest gamma point. And then when it gets up to 200, that $1 option can become a $5 option in a snap. So that's one choice. But hey, if we think that that bounce could be more of a fizzle outer bounce, just get up to 185 or 187 or 190, then we're way better with an at the money or even an in the money option. Why? Because they have a higher delta as well. And by the way, what is delta? Like, we don't have to get all fancy and put, know the exact delta for what we're talking about, but just the concept is important. Delta is the rate of change of the option's value relative to a change in the underlying stock price. Means if the stock goes up by $1, one that has a big delta, that call goes up by a lot. A call that has a small delta, the call goes up just by a little. So basically, for smaller moves, we want bigger deltas, which are more at the money or in the money. For bigger moves, we can accept smaller deltas because we just get a much bigger percentage profit and we risk less. So, okay. Now, there were, who is that? FG, I think it was, said he or she was new to options. Well, if you're not sure even like what a call is or how it works or anything, here's what you want to be able to do. You want to be able to visualize in your mind's eye the risk reward of every type of option position. A long call is arguably the easiest one. It looks like a hockey stick. So the idea is, if I pay $1 for these options for the 190 calls and Amazon's at 182.80, here's the strike, 182.80, or no, 190. Here's the stock price, 182.80. If the stock stays below 190 and I hold it all the way until expiration, the most I can lose is what I paid for that call, which in this case is $1. But if Amazon rises above 190, and if it rises far enough above there that it covers that $1 that I paid for it, so this is really the break-even point is really 191, then the higher Amazon goes, the more I can make. I can have unlimited profits. Now, what we're looking at here is called a profit and loss diagram. Write that down, profit and loss diagram, or just for short, P&L diagram. If you're not sure how to draw these out on a piece of paper, old-fashioned, like your grandparents used to do. You take one of these things that they used to sell called pens, P-E-N, and a piece of paper, which, back in the days, they used to cut trees down and make paper out of them, and you would take the pen and write on them. Yeah, I'm being a little bit facetious here, but like it will serve you very, very well to be able to draw one of these diagrams on a piece of paper. And then if you do that enough times, visualize it in your brain and you won't have to draw it anymore. So especially if you're just starting out in options, or maybe you've been doing it a while, but you've never really thought about risk reward in this manner, it is essential that you get extremely good with drawing and then consequently visualizing profit and loss diagrams. And so I wanted to give you something special today. We actually have a class it's free, doesn't cost you anything, that teaches you how to draw profit and loss diagrams. So if you go to our website, which is just markettaker.com, and click on join free in the top right-hand corner, and then you just create an account, and you can just navigate right here under fast tracks to the options risk analysis training course that teaches you how to draw these profit and loss diagrams. Okay, so the long call one's easy. The most you can lose is what you pay for it. The break even is the strike price plus the premium paid, and the profit is potentially unlimited. Now, this specifically is an at expiration profit and loss diagram. So this is the underlying at expiration. Before expiration, we get something that looks a little bit more like this. Now, this is an artist's rendition, and I am not a graphic artist. And I don't have the skills, and I don't have the tools. So you'll have to excuse the very wobbly line that I drew freehand with my, my trackpad here. Basically, here's the idea. At expiration is the solid, straight, and kinked gray line with the arrows. But today is the dotted line. And tomorrow, because of time passing, what do they call time passing in the options world? Who can tell me? We're going to get to know each other lots over the next several months. Decay. Nice, Diane. Decay, says Charon. Great. Nice work. So as time passes, options decay in value. So basically, this dotted line goes down just a little bit every day until at expiration, it finally becomes the straight gray kinked line. There's also something. Now let's see who's really clever here. Actually, you know what? I'll save that for a second. Actually, no, you know what? I will ask that question. So what happens if a big trading firm like Goldman Sachs or JP Morgan or Citigroup comes in and they buy 10,000 of these calls? And let's assume they do it all in one fell swoop, one trade. And we also assume that the stock doesn't go up or down, doesn't change price. Citigroup comes in and buys 1,000 of these options. Option prices increase. Yes, because of supply and demand. Yes. And that is called volatility. You guys are smart. I love this. I like doing these workshops with smart traders. I'm going to have to start getting more advanced as we go through this stuff. I'm just telling you. You better get ready for next week. All right. So the thing is when stocks go up or down, there's something else that changes. Well, if the demand increases, let me back up. If the demand increases because JP Morgan bought 10,000 of these, this dotted line would go up because of implied volatility. If Goldman Sachs sells 10,000 of these, dotted line will go down because of implied volatility. But, you know, there's also another thing about implied volatility. When stocks fall, even though they might lose because of direction, because of delta, holy cow, we're just like throwing out all these more advanced terms. If you don't understand all these advanced terms, you're not familiar with the Greeks or volatility, don't worry. We're going to go back to this being really, really simple in a second. But I just wanted to kind of test the waters and see what the level of sophistication is here. And I'll keep mixing it up a little bit. I'll keep trying to keep it basic enough for everybody to understand, but throwing in some more advanced terms so that the more advanced folks get things out of this, and the more basic folks just learn at a faster rate. That sound good? Oh, awesome, Omega. Great. So when stocks fall, even though like the call will lose value because of direction, delta, but what happens a lot is that makes other traders nervous. And it makes them buy other options in this stock, which makes the price of all options go up. It makes implied volatility go up. So when that happens, and you know, we've got a chart like the one we were just looking at. Let's go back to this Amazon chart. After this, what probably happened is that implied volatility, or the supply and demand thing for options, probably went up. And so the options could be, well, thank you, Omega. I much appreciate that. This is not my first rodeo. But I appreciate that I'm staying on track for you, for sure. So that being said, if these calls are already expensive, when they go, one of the risks we have is when the stock goes back up, we make money on the stock going up, delta, but then that supply and demand component goes down. That's when people sell off their puts. They start selling covered calls because they get more complacent. And so we've got the delta that helps us, but the implied volatility that hurts us. Usually the delta can help us more than the implied volatility hurts us, but it's something we have to think about because we're constructing an option strategy. And if we're bullish, we don't just have to buy calls. In fact, we could trade a put credit spread. Now, again, if you're brand new to options, you're not familiar with spreads yet, no big deal. Just internalize this conceptually, and you'll get more and more advanced as you attend my workshops in the future. So here, what if we did this? What if we sold the 180 puts and then bought the 175 puts? Geez, what would that even be like? Well, it kind of looks like this. These are the 180 puts. These are the 175 puts. If Amazon was at 182.80 when we put this trade on, and we collected, let's see, if we sold the 180 puts, we would have sold them at about, well, let's just say 185 and bought these at 75. So we would have collected 185, paid 75. So we would have collected a net of $1.10. If the stock, Amazon, is above both of the put strikes, and it stays above it, meaning the stock doesn't go down below 180 between now and expiration, what happens? At expiration, both of those puts expire. They just disappear, cease to exist, and that $1.10 that we collected is ours to keep. We'd reach our maximum profit. But what happens if Amazon goes down and is below 180, but above 175? Well, if it is, then at expiration, the 180 puts would get assigned. We would get a long stock position. And the lower the stock goes, the worse. Until, of course, it goes down below 175, where we can then exercise that put and sell the stock that we bought at 185 at 175 and stop the bleeding, and we have a maximum loss. The maximum loss is the difference between the two strike prices. So 185 minus 175 is 10, minus the premium collected, which is $1.10. So the maximum loss would be $8.90. So you look at it, we can lose a lot more than we can win. But if you think about it, we're kind of starting out at a bit of an advantage. See, professors would say that stock prices are log normally distributed. Now, that's another one of those big fancy words that I don't care if you have totally down pat or anything. All that means is stock prices are kind of like a bell curve. Little moves happen a lot more often than really, really big moves, up or down. That is, in fact, what the whole options pricing model created by Fisher Black and Myron Scholes back in 73 is based on. So you got to take that with a lot more than a grain of salt. I always forget if you should say more than a grain of salt or less than a grain of salt. What does that even mean, grain of salt? Why do you take it with a grain of salt? So anyway, if Amazon is at 182.80, so basically like here, we've already got a head start. If there's a 50-50 chance of it going up or down, which, you know, there almost is if you believe professors, at least in the short term over 5 days, then if it goes up, your put spread wins. If it goes down a little bit, your put spread still wins. It just does, as long as it doesn't go down below 180. So it can go down a whole $2.80. So if you think about like that bell curve, more of the bell curve represents a win for you than a loss for you. But we could go further out of the money and sell maybe the 177.5 puts at $1.18 and buy the 172.5 puts at 47 cents. Now we'd collect less than, what would we collect? We'd collect 71 cents as opposed to $1.10. And it's a $5 widespread. Oh, my other spread was a $5 widespread too. So I wouldn't be risking $8.90. I'd be risking $3.90. So not nearly as bad as I said before. Sorry about that. Here, your risk reward is a little bit worse because remember, your maximum profit is the premium you collect. So 71 cents, 118 minus 47 is 71 cents. And the maximum risk is the difference between the strike price is 5 minus 71 cents. So that's $1.29. So your risk reward is worse, but your likelihood of success is better because selling the 180, 175 put spread, Amazon can only fall 280 before you run into trouble. Here it can fall an extra $2.50. So basically, this graph right here, the whole thing kind of goes lower, but the strikes, but it kind of shifts to the left more. Your likelihood of success goes up, but your risk reward goes down. We always have that trade-off. That is the trade-off. It makes it salty. Yeah, but 1 grain of salt, it doesn't make it that much more salty. Just a little bit. All right, so anyway, we could buy calls, we could sell a put credit spread. If the volatility is high, selling options, because they might be overpriced, could be something we might want to do. And this trade is very theta contingent. With a long call, the faster it goes up, the less time decay can hurt us. selling a put credit spread, the more time that passes, the more it helps us because time decay helps us. And then finally, the third opportunity I want to look at is the call debit spread. So that is buying a call spread. So before the first of these three choices that I'm going to go over, and there's more choices, but the first of three choices was buying a call. Maybe I buy the 180 calls, maybe the 185 calls, maybe the 190 calls. Well, what if I bought the 180 calls, but then sold the 190 calls? I mean, if I think there's going to be a small move, maybe just up to 190 at the most. If I buy the 180 calls, I'm risking $5.30. But if I buy the 180s and sell the 190s, yeah, I'm risking $5.30 on here, but I'm selling these at, let's just round it to $1 to make it easy. I'm collecting $1, so I'm really only risking $4.30. And if the Amazon goes up to $1.90, I actually make more money, not just percentage-wise, but more overall. So basically, where the long call was sort of your hockey stick, this is a truncated hockey stick. A hockey stick where it's not maximum profit, it's a limited profit, but it's more limited risk. Instead of risking $5.30 down here, or wait, $5.30? Yeah. Instead of risking $5.30 on the 180 calls, we're only risking $4.30 on the 180, 190 call spread. And if it only goes up to 190, the 190 calls expire, and I get to keep that $1, and I still make, this call is still worth $10. Exercise the call at 180 to buy the stock at 180. I could sell it at 190. And I paid $4.30 for it instead of $5.30 for it. The trade-off is if the stock goes up to 200, then I would make more with the long call and less with the call debit spread. We're always seeking the best risk reward versus likelihood of success. Thank you, Chirag. I really, really appreciate it. And I hope to see you next week and the week after and the week after, my friend. So, look, this is the lesson for putting on the trade. We look for the opportunity. We go through our complete forecast, which includes direction, degree of direction, time, volatility, which is, and the volatility is definitely a more advanced concept that we'll cover in the weeks that come. So these are the things you need to consider. Do I want to buy a call, sell a put credit spread, buy a call debit spread? All of them make money when the stock goes up, but they're for different scenarios. Which is the best? And then among them, I talked about buying the 180 calls and selling the 190 calls. Well, I can do that, instead of 5 days to expiration, I could do a 12 days to expiration. Or I could buy the 185 calls and pay a lot less, pay half what I'd pay for the 180 calls and sell the 190 calls or the 195 calls. It changes my break even. There's less likelihood of success if I go further out of the money, but I risk a lot less and I make a lot more if I'm right. Okay, so that's getting into the trade. That's maximizing your opportunities. Now let's talk about managing these trades. So if I were to go with the long call, we got to think about the risk. And when we think about the risk, we've also got to think about the reward. So the profit target, we've got to do two things. We've got to think about the profit target, and we've got to think about the risk. So let's first think about the good scenario. We're right. The stock does bounce off the support at 183 and it goes up, I'm going to want to set a profit target. If I bought these calls at 280 or whatever, $2.80, of option premium or 530 or whatever it is, what price am I going to sell those calls? Well, here's what we do. It is a better practice to key off something on the chart rather than a percent. And I know a lot of people, frankly, I think with less experience, will tell you, oh yeah, try and get a 50% profit or an 80% profit. And is that like horribly, horribly wrong? No, but keep in mind that, look, the market, this chart that you're looking at, doesn't know that you paid $5.30 for these calls. It doesn't know that. So why would you anchor your profit target to that arbitrary thing? I mean, it's not arbitrary to you because you paid $5.30 for it, but it is arbitrary to the market. But it's not arbitrary to the market? Technical analysis, resistance lines, RSI, things like that, slow stochastics. So if I bought these calls here, whatever I paid for them, what I'd rather be doing is saying, well, where's the next resistance level? Well, there's some resistance at 188. There's stronger resistance at about 189. There's more resistance here at about 192.5. This really strong resistance at 200. Can it break through all this resistance and get up to 200 on a 5 or 12-day option? And, I mean, it's intuitively unlikely because most of the time, big moves happen to the downside and slower moves happen to the upside. I mean, even here where we had a pretty good move to the upside, it took 1, 2, 3, 4, 5, 6 days to go from 190 to 175, but it took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 to get back up there. And there's always exceptions to the rules, but we're just talking statistics. That's what trading's all about, right? So yeah, we probably want to put a target at like, hey, if we get up to 190, I'm going to sell my calls out. Or if we get up to 188, I'm going to sell out half of my calls and sell the rest if it gets up to 190. Or I'm going to sell these things. I'm going to ride RSI, but if RSI gets into overbought territory, I'm going to sell. So these end up in the long run giving you better risk management from the profit-taking perspective. Now, guess what? I know there's a few people who are really just starting out here, so you may not know this yet, but I'm going to let you in on a big secret. Not every one of your trades is going to be a winner. You're going to have some losing trades. Big secret. Sorry to break that news to you. That's all part of it. So we also need to manage our risk by setting a stop loss, which means, hey, if I bought these calls at 580, I'm going to sell them at some lower price if it goes down to that. Now, it is a little bit tough to pin it to a technical level. You might be able to set an alert. Hey, here's lower support. Like let's go back to that chart. Hey, there's lower support here at 180. I'll set an alert if it goes down to 180, then I'm going to sell the call. Or, I mean, in this case, I would be okay with you saying, I'm going to risk 20% on the call because you probably sell the call at a much higher percentage if it's profit. So what you do is you set your profit target order here, and then you set your stop order here, and you set these OCO. One cancels the other. Because what you don't want to have happen is the stock go down, you get stopped out and you sell that long call, but then it goes back up and now you're short calls in a rising market. So if one of the orders gets filled, you want to cancel the other one. Okay, managing the put credit spread. So here we're left with no choice than to set a percentage of the max profit. Because remember, what's the maximum profit on a put credit spread? It's the premium you receive. And you only make that from time passing. You can make a little bit on direction or delta, but it's mainly on time passing. So there's not you can't chart out time. I mean, you can chart out time. It's called a calendar, but it's pretty boring looking. It looks the same every day, every week, every month, every year, every decade, every century, millennium. So we need to set this as a percentage. Now, as much as I showed you profit and loss diagrams of holding the stock until expiration or holding the position until expiration, we're never going to do that. We always want to take off these trades before expiration. Why? Because at some point, we will have gotten the lion's share of our profit, and we can only make a little bit more, but if it turns around, we can lose everything we made and a whole lot more. So we want to close before expiration at a 60 to 90% of the maximum profit level. But on a put credit spread, if the stock goes lower and breaks through support, we're going to take a loss. Now, the next support level is about 180. So if it goes below 180, we're going to take our loss. Now, really, we always want to set our strike price for put credit spreads at or below support. So an easier heuristic is just to remember, hey, if the stock goes through our short strike, we're going to close the credit spread. How about the call debit spread? Well, here we're going to be a little bit more conservative. We're going to close it before expiration if we reach 60 to 80% of our max profit. Now, our max profit here is bigger because we got more room to run to the upside. So we can close it a little bit sooner. We're not going to wait for 90% of it. We'll definitely be out by 80% of our maximum profit. And if it goes down, if it breaks through the next support level, that's where we're going to take our loss. Now, we're not going to set an actual stop loss for a spread because there's two bid-ask spreads, so that tends to not really work out very well. It's much better for you to trade these manually so that you can enter an order in the middle of the market, where a stop will always execute at the worst prices, selling the bid on the one and buying the offer on the other. Okay, we talked a lot today, and I've got about 5 more minutes to share with you. Right now, I would like to take your questions. So if you have a question, throw it in the questions Q&A box, and I'd be happy to answer it. So Omega says, Dan, with options, are you also looking at the support level as well? I see Omega typed that before I started talking about this. So yes, definitely always doing that. There's 3 analyses we want to do if we're an option trader: technical analysis, fundamental analysis, and volatility analysis. All 3 of those. And the fundamental analysis, we don't really get that fancy with. If you stick with my class, which I hope you will, and you attend every week, we're going to have these every week on Tuesdays at this time, which was noon Central, or no, noon Eastern, except next week. I'm out of town next week, so it's going to be on Friday of next week. So that being said, stick with my classes, and yeah, we're going to cover the technical analysis aspects, the Greeks, volatility, what you need to know about fundamentals. What else we have? Selling puts to generate income, selling credit spreads to generate income. Oh my goodness, we've got lots and lots of great things. Are there any final questions that I can answer to uh, help make sure that you got everything down pat? You are welcome. And remember, my gift to you is if you could just go to markettaker.com, two T's in a row, market like stock market, taker like take what is rightfully yours, markettaker.com, and click on join free, and then go here. This is a very simple, basic, very basic level course on drawing profit and loss diagrams. And that's something that's super important. If you can't do that in your head in a snap, I want you to go and watch that course. It's free. You're welcome. You're welcome. You're welcome. Am I a bull or a bear? Yes. Yes, I am. Depends on it depends. If anybody's always a bull every single day for a decade, they don't know what the heck they're talking about. And if they're always a bear every single day for a decade, they also don't know what they're talking about. Clearly, the statistics show that if you buy and hold over the long run, you make 8 to 10% a year, depending on how you parse the numbers. So in that regard, I guess if somebody has to be blindfolded, gun to your head, are you a bull or a bear? Okay, in the long run, it's going to work out better being a bull. But right now, or next year, or last year, you're always going to get a different answer if you're talking to somebody who knows what they're talking about. Maurice says, for a sudden pullback like last week in April, how do you manage risk on calls and spreads? That last bit that I showed you, you always want to be managing your risk. With calls, you always want to have a stop loss order. With spreads, if it goes against you, with credit spreads, if it goes through the short strike, you just want to close it and be out. With debit spreads, if it goes against you and it goes through the next level of support, if it's call spread, you got to be out. Managing your risk is key. All right, Omega, I'll see you too. And that's it. We are finito here, my friends. Thank you for joining me and thanks for sharing your time with me. I hope that I provided value to you, and I will see you next week to do more of the same. Tell your friends and join us, and I will see you next time.